First article at the top, Federal Reserve holds interest rates steady and sets the stage for cuts. What this means for your money. Okay,
Yay.
so you guys already saw this by this point. The Fed held steady rates at the end of its 2-day meeting last Wednesday, which would have been January 31st, the end of the month. Oh my gosh, the month is already, the first month of the year is already done. Which sets the stage for rate cuts. Now, here's what we're going to talk about up top, though, is, we were talking before about how many rate cuts we think it's going to happen. Some people last year were saying, they're setting the stage in December for 5 to 6 rate cuts. Like, that's going to be freaking every meeting. Yeah. Not going to happen. And then some people say, they should do it twice. And some people, they shouldn't do it at all. So this is coming out and saying we should probably see 3. I mean, do you agree with this? Should it be 3 only? I mean, we were just talking in the last show about they'll probably start one in April. Now that's up for grabs, and maybe that won't happen. I mean, what do you guys make of this?
So I think, and I got asked this the other day, after the Fed came up, they were like, so why didn't they make a decision? And I feel it's because of data that still needs to be unpacked from last year. And then moving into this year, having a full quarter of data, moving into the new year, like we spoke about last time in our podcast, I think that would give them, enough information to really dictate what the direction of, monetary policy needs to be going into the new year. And I believe that's, what they're going to be doing as they come into the next meeting, saying, hey, this is the direction we're going to move. They might not cut or take a decision, but they might say what they're looking to do as they progress forward.
Yeah, everything that's just intended with the Fed, I mean, I like the way they just kind of give some type of anticipation. It just gets everybody to anticipate what's going to happen. But obviously, a lot of people are already predicting that we would already seen a rate cut already by this point, by this meeting. It didn't happen.
Yeah, no,
it didn't happen.
No, and it's not going to happen right out the gate. I think you're right. I think one of your smart friends told you at the last show. Yeah, someone who's on this show with you guys said that we're going to probably wait for the first quarter, the data to come out, and I think it just will. I think that they have to wait because there's a part of this where doing something too soon will nullify their credibility, or at least dent their credibility if they have any left. Oh, watch the comments go off right now. The Fed, what are you talking about credibility in the Fed? There's no credibility at all.
But it goes against, I think everybody has their opinion mixed in this as well. So you hear a whole bunch of headlines. I would refrain from that and focus on the data.
And I understand. So let's talk about the data, because what some people consider the data is going to be the economic stuff, and some people say what they tell you, and the dot plot chart, like the blue chart with those little dots where all the Fed members project what they think it should be by the end of 24 into 25. So then based on the projections, the analysts go, that means they're going to have 5 or 6 rate cuts or 3 or 4 or whatever. Those are still predictions. It's not the data. But they are telling you that there's some division even among the Fed members of what they are going to do and when. Now, by the way, for any of you who are new to the show and you don't understand what the Fed rate is, this is the rate at which banks borrow money from each other overnight. So it's very short-term lending. But that precedent and that sentiment does bleed into all sorts of lending, different parts of lending, and changes what rates look like for car loans, credit cards,
everything,
line of credits, and then weighs in on mortgages ultimately.
Basically, for my my Gen Z people, based on the vibe the Fed is feeling, we'll understand how the outlook's going to be.
They had a pretty mid
Gen Z advocate.
They had a pretty mid meeting this month.
Yeah. Facts.
Yeah, I mean, we got to see prior to the rate hikes, the banks were borrowing money at 0% from the Fed.
Right, for a long time.
The Fed funds rate was 0.
Yeah, 0 to 0.25%. Free money.
Yeah.
Free money.
And so that's why we saw the low interest rate environment.
Yeah. And then one of the things the article does say is interest rates took the elevator going up. They did. They spiked it up real quick. But they're going to take the stairs coming down. And I think this is very, very well said. And it puts, perspective into what everybody's saying. They're going to rate hike. They're going to rate hike. Rate cut.
Yeah.
But if you start cutting too soon, then we go right back to where we were at in the beginning. All the progress that we made would then digress, and nothing would really get accomplished. Back to the same thing.
There's a little bit of the damned if you do, damned if you don't, right? That's kind of the game. It's always this teeter-totter, and it's been that way forever. But the interesting thing you just brought up, though, is that interest rates were held artificially low for so long.
I think he was barely born when
you're eventually going to pay the consequence for that. It's like, the term, the chickens have to come home to roost. Like, this is that. Like, we're going to have to basically pay the price for a little bit of time here while this, mellows out. And we're going to have problems. There's going to be continued inflation. There's going to be reinflation. Watch for that word. If you haven't been hearing the word reinflation Yet, look for that here in the month of February. You're going to start hearing reinflation. And just like in 2023, the quote of the year for housing and real estate was date the rate, marry the home.
Yeah.
This is going to be 2024's quote. I'm going to call it right now. Blast me in the comments if I'm wrong later.
Yeah.
But this is going to be the quote of 2024, which is what Brian just said. Interest rates took the elevator going up, and they're going to take the stairs coming down.
Yeah. And this is despite them even knowing that 60% of the American households are actually living paycheck to paycheck.
And I think it's higher than that. I think it could be higher than that.
But come on, we got to
No, I know.
the numbers. And it's still, I mean,
That's
still
still
60% is a lot.
That's a lot. Yeah, I mean,
You
think
know?
about 6 out of every 10 people you talk to
Yeah.
are going paycheck to paycheck. That's
Or
extremely difficult.
10 out of your neighbors that you go and they're probably saying, no, everything's great. Yeah, right.
And you know what sucks and puts a damper on all this? That on paper it looks like, everything's good, the economy's growing, but in reality people are suffering at home. I mean, prices aren't deflating fast enough, and I mean, just goes to show that people are still not making it out of the woods yet.
No, it's true. But again, they're borrowing now, paying later with the same mindset and mentality that we had before, and it was working, right?
Correct.
That's not working right now. I mean, we're still at the highest consumer debt there's been ever, right? We see Amazon's, and that's what people don't realize. Amazon came with a huge profit.
Yeah.
Yep.
Right
Yeah.
after the holidays, And so those things, then you got Meta. Like you have all these things that are just showing like on paper, we made a ton of money.
Yeah, and you're going to see more layoffs because they're happening anyways. There's always like courses of
mention that,
layoffs.
yeah.
There's always seasonal layoffs,
Yeah.
but you're going to start seeing more layoffs partly because of the economic pressure on companies, partly because of the high cost of companies operating run costs due to the debt that they're carrying and the Fed funds rate. That's like this top, moving up to the different levels of those conversations. But
real
you're
nerd
also
stuff.
seeing like things as simple or as complicated as like AI and technology that helps helps do things faster, quicker, or more accurate, or more whatever, more with more volume. Pick your topic.
Efficient without paying hourly fee.
Well, right, and people cost money. Like that's the bottom line.
true.
But I think this is what when you're talking about the 60% of households that are living paycheck to paycheck. Like this is the evidence that like the problem you cause over here shows up somewhere
Correct.
else. So if you like suppress something over here, it'll pop up over there. And if something pops up over here, you got to suppress it over there.
Yeah. And then, I mean, although they said, with rates cuts on the horizon, consumers will see some of their borrowing costs come down. And that makes sense. But you can't, just go over the fact that they racked up all this debt.
Well, it's come down, but here, let me give you an example. Like, let's
It's
say you
still
had
there.
a 15% card
Yeah.
that went up to 30 and it returns to 25. Okay, so it went from 30% to 25. Like, does that help somebody?
So
Probably
I
not.
have a question. So if you had the option to pay anywhere between 16 to 21% on your debt, or anywhere between 6 to 7%, which one will you take?
I'm taking the lowest, 6.
I feel like you're trying to you're baking in,
Yeah,
baking
well,
in a
here,
refinance.
and no. And here's the other thing too, is that other debt at 20, and if you go above the credit limit, if people don't read the little fine print,
Boom.
But that's it. It's like they already broke their agreement.
Now
with
you're
the
on a
credit card.
whole different level.
Total different.
That's right.
Interest rate. So
Yeah.
you could be
And-
even at a 32.
And then I'm going to bring it back to that. So people that are going through a financial distress situation right now, they probably, if they own a house, probably have a sub 3% rate. But because of the fact that their mind is so stuck on this low rate, emotionally, a huge emotional, they're not seeing the opportunity of being able to move this debt over here, consolidate it over here. And I'm not saying everybody should do this and go call me for a refinance. No,
Right,
I'm
right,
just
right.
trying to break down the importance of, hey, you're paying this much on this debt over here that is variable, moving up and down, and you can't do anything about it until... No, you can't do anything about it.
Yeah, in all fairness,
but if you bring it into your mortgage, now you have free cash flow. Your debt then consolidated to a lower rate,
And
which
it's
is
a tax
now-
write-off.
And it's a tax write-off.
Right.
You still have that credit limit to be able to use, but now you consolidated that into a better, easy payment.
One word.
Consolidation.
Leverage.
leverage, consolidation, something else.
Which one?
No,
Give me a
but
word.
in all fairness, though, I'm glad you mentioned that because this is not for everybody, and not every situation mathematically.
Definitely
will
not
work
trying to
out.
push shameless
So look, there are situations where that's going to work out, guys. Like, duh, we're in the business of doing this, so like it does make sense. And a lot of times, and last year we had several episodes where you guys delivered on show evidence of real case studies where you save someone. $1,200. One of you had saved $1,300.
Yeah, it was
$575 was like another one. And it's like, okay, that actually represents real change for somebody, but it's not gonna matter for everybody. They made a qualifier, whatever the reason is. But I think the takeaway here is that you have to step away from the emotional part of that decision and go, what aids me moving forward in the decisions I'm trying to make for my life and the milestones I'm trying to hit.
Yep.
How can I get there, and what do I have to do today in order to get there along the way? That I think is what the big takeaway is from that part.
Yeah, and it goes with everything. I just feel it's more on the consumer's habits more than, what's happening with the economy, because we can't control the economy and how that's going to, take.
But they're linked. But they're linked, because when milk was $4 last year and it's $8 now, not a real example, but if it changes overnight like that and I still have to buy milk or eggs or whatever, that's not just me like flippantly spending money unnecessarily. That's like me buying the things I have to buy. So it is part economy and it's part behavior. To me, they go together.
And I guess I meant it in a certain subject, like when you're buying a house. If you got to pay for gas, energy, bills, like regardless, you have to pay for that. But now if you're looking at it from an investment point of view, where it's like, well, should I make that move right now or should I not make the move? I think that it's more about having the right information and not really falling behind on, past experiences or anybody else's experiences. But one thing that our guest said on the podcast that we recorded before this was that regardless of what people want to do, they're going to want to find the solution that fits their problem.
Yes.
And once they find out and they know what steps they need to take into doing that, it opens up more of a confidence for them to take those steps without having to be like, damn, I don't know if I should do this. This is going to like pan out the wrong way. So.
Yeah, no, that's a good point. And to kind of round out this part of this conversation, like the Fed eventually making rate cuts, everybody watching, is going to affect auto loans. It will affect credit cards. It is going to affect other things that as a consumer you are paying for or connected to. Now, on the other side, like, I know I had kind of barked out, oh, it's probably more than 60%. It might be more than 60%. That might be 60% that are admitting it.
That's what I'm saying. There's people that are silently suffering.
It could be 60% that are admitting it. But,
it's so true.
The whole credit card situation, auto loan situation, there's only so much you can take. And we've, in the mortgage space, talked about October 2023 ad nauseum. And when rates hit 8%, that was like the hand touching the fire on the stove. And whoop, we immediately like, nope, we don't like that. No one liked that. The market didn't like that. And the consumers didn't like that. And so I think you're seeing the same thing here. It's gonna happen. We cannot have people get out of their financial problems while also holding 30% APR rates on their credit cards.
There's no chance.
Well, hey, guys, the good thing is that last year, the income levels went up by 19%. 19 cents. I'm sorry, 19 cents.
I'm like,
average hourly wage.
Yeah, the average hourly wage was $34.55, Andy. And
it went up like
we got 19 cents.
Like, well,
good. So that's going to take care of an inflation issue. And I think if you multiply that, right, you multiply that by 40 hours a week, 52 weeks in the year.
Heck yeah, you
it
can
was
buy
like
eggs.
71,000 and change.
Yeah, you're still talking
That's
about
still like the nationwide
average take home.
The average, come on now.
It is, we're still going to be circling the wagons around this affordability issue. The one thing I want to make sure that I bring up specifically here is Doug Duncan, one of our friends, Doug Duncan, who is the chief economist at Fannie Mae, and he was talking about that he doesn't see affordability problem solved until supply increases substantially, interest rates come down, and real income rise. So he's talking three major variables have to all move in concert for this to work out. So the affordability will get solved with an increase of supply, interest rates coming down. He's saying probably dip below 6%, and then also real income rises. So it's a combination of all these things.
Which one of these do you guys see actually happening, though?
Well, I think. Well, we had talked about supply in the last show, and we made our predictions. I think supply is going to show up because people are going to have it show up. I think selling their home is going to be some people's way out of their problems financially.
100%.
If refinance doesn't work, they're going to sell. Okay. I think interest rates coming down is going to be a byproduct of being election year, number one. Fed reducing interest rates, number two, especially if they're going to do 3 rate cuts, even if there's 4. And then real income rising, I think for the people who have jobs, it will rise. Subtext. I think you're going to have a lot more unemployment this year.
For those that keep their jobs, they might get a raise.
But here's
lots of layoffs.
Here's why, and I don't know where this is being talked about yet. So if you're watching this segment of the show, and you can put a comment in with a link, I think that what's going to happen is the people that are going to have continuity of their employment are going to get raises substantially because it's going to be necessary to keep good employees, number one. Number two, they're going to have to pay for all the bills. And number three, the talent you have to keep, you have to pay.
Yeah.
Because you can't AI everything. You cannot AI unplugging your shower drain. Someone's going to have to come and do that.
Yeah.
You can't AI your oil change. So my point is there's a lot of jobs still out there where there's a person that has to do something for the outcome to happen.
We need welders.
And I think there will be real income rise. I don't know if, as long as it can outpace inflation, I think we're going to be fine. But if it does not outpace inflation, then we're in trouble. Lastly, for me, guys, is on this, I want to talk about the savings rate really quick because there is a substantial... is substantial the right word? To me, it's notable. Let's use notable. I think it's notable that you can still get a CD now that outpaces inflation.
Yeah.
Because that was not the case for a long time.
Ever.
I mean, money market, we're like less than 1% return for a 12-month commitment, $100,000 minimum, or even $50,000 minimum. But now because of the Fed increasing rates as fast as they did since March 22, those yields have been in great favor for people who've parked money.
Right.
Correct.
And that means to me, if you have the money and you can park it for 6 months, 9 months, 12 months, and it's going to outpace inflation, do it.
Yeah. Well, here's the thing. You don't even have to go that far and put in a CD where it's just you're going to have to put it there for a certain amount of time, right? Now, a savings account, you go to SoFi or whatever, you could just Google APY, annual percentage yield. They're paying like 5.5%, 6%. Before, they weren't doing that because people were just giving the bank a problem by putting all their savings in there.
Right.
Now the banks are like, wait a minute, people aren't saving. And we're one of the worst countries to save money.
Yeah.
Right?
Economy.
But how do I encourage people to still come and deposit money?
Give the money.
Well, I got to give them a bigger
Gotta have a
annual
return.
percentage yield, right?
Yep.
And so I'm going to entice them by giving them 5.5% or 6%. And now I'm starting to see more of that in the last, it's been a few months now that we've seen that happen. But
that's going to carry out
crazy.
through 2024 because even if the Fed cuts rates and they do 0.25% rate cuts, let's say there's 3 of them. Okay, well, that's still going to be a return on your money being parked that's higher than inflation, or it's even higher than the inflation projection, I think. So I think that's still going to be good for people. So if there's any positive about this rate cut part of what's happening in 2024, you're still going to be able to get a good return on your money if you park it.
We'll see. I mean, we'll see, right? Once that starts going down too and the banks are borrowing money for less, let's see if they want to pass that on to the consumer because a lot of times they don't.
That should be your token takeaway. We'll see.
We'll see.
William, no, we'll see. We'll see.
You know?
Not just doubting Andy, but we'll see.
Correct.
We'll see.
I don't doubt it. It's just...
We'll see.
We'll see.